boy, oh boy, look at this market. It is rough. It looks like we are getting a nice little correction here. So of course the question on everybody's mind is, should I buy the dip? So you're going to want to buy the dip if you think the long-term trend is higher for the stock market, because every time, prices go lower, you're getting an opportunity to buy your positions for cheaper. And the thought is that the market will turn around and you got it for a cheaper price. There you go. Better returns as the stocks go higher. But obviously if you're trying to buy the dip, there are risks. Like, what if it isn't a dip? What if it's the start of a market crash? Then you're going to be in trouble, right? And also, how do you know when to actually buy? Like, what is a dip? Is it a 1% drop, 2%, 3%, 4%? What is it? So everyone talks about buying the dip, but how do you actually do it? Well, that's what we're going to talk about in this video. And when I'm talking about buying the dip here, remember, it's just one potential strategy, and it's not even a full strategy that I'm talking about, just one aspect of it. If you want to know how to build a full strategy, then check out Strategy Builder Pro, where we'll get you from zero to a professional grade investment strategy. But this is only open for enrollment until Sunday, so check it out. There's a link down below in the description and comments of this video. Okay, so the reason why I wanted to talk about buying the dip is because it leads into the conversation of when you should actually add more money to your account. And this is more of an advanced topic because it becomes kind of discretionary. Because yeah, we all have money in the market, but from our jobs or our other sources of income, what we want to do is keep investing, so keep adding. But there's a few different ways to do that. Now, you guys know I always talk about how I'm a systematic trader. I use a momentum strategy, so everything is really laid out. I just follow the rules. I don't like discretionary stuff, like trying to figure out what's happening right now and what I should do in the moment. I like it all pre-planned. But there is a weakness to my strategy, and that's what I was just talking about, when to add more money. Not the money that's already in your account, but from outside. Because that, if you think about it, can really affect your returns. Like if you add in a bunch of new money at the top and then all of a sudden you see a big drop, well, you're going to take a large loss, right? That's going to take some time to recover. And it sucks because you just added that money and you already have a loss on it. But then there's the other side of the coin too, right? If you buy a dip, then you have a potential for quick returns. So I can take you guys back to February of 2018. Remember what happened back then? Market collapsed a good 10% in very quick succession. And you know where I added a bunch of money? Right here, literally on this last green bar. And then it took a turn. And that was a big chunk of money and I was hurting for it. Now, of course, when I'm talking about this stuff, it's short term. If you look at your total returns over 5 or 10 years, it's not going to matter as much. But if you're more active and more into trading, then you might want to, adjust for this and optimize it so that you don't take that short-term loss. So like I said, there's a few ways to add money to your account, and how you do it is going to depend on how you're investing and what you feel comfortable with. So I was talking to my best friend who's a financial advisor, and I asked him, what do you tell your clients? And his rule is that you just keep adding whenever. And he focuses on people continuing to add to their account, because that's how you build your retirement, right? And it's just small chunks as they get money, hey, save this much and put it into your account. And on his side, he's not trying to time the market as much, because it doesn't matter for his clients either. They're long term, they're looking at retirement. So you don't need to game the little dips. As long as you think the market is going higher, you don't have to stress it. So they take the same approach as, say, your 401k, which, is taking a little bit from your paycheck each month and putting it in. And this absolutely works. I agree with it. It's the right way to do it for most people, especially if you don't want to be as active in the market. It's less stress and it's effective. The trick there, though, is just to stay consistent. Keep adding when the market is going up and keep adding as it's going lower too, because you're not trying to time it. Now, in my case, because of the nature of my business and how I get paid, I get random chunks of money at random times. It's not steady. Sometimes it's big, sometimes it's small, and really it's the crappy part about being a business owner. But I mean, it's nice when there's a big chunk randomly. But because of that, trying to add money to my investment portfolio in regular intervals becomes annoying, and it's tough. So if I want to add a large portion all at once, then, well, I need a more active strategy, because this February 2018 thing, that really hurt. And in this case, I do prefer to be a little more active, and I would like to buy the dip. And I kind of have to, because if I add a large portion of money, it's going to affect the account P&L more than if you're just doing the smaller pieces. So if you've watched my market review videos with our research firm Macro Ops, then you know that we're bullish long term. Like, our research shows that even this correction right here, if you watched our last video, it is just part of the natural bull trend. It's a natural correction. It's not the start of a market crash. So considering that, and considering the fact that I run systems that bet on the market going higher, because the market does go higher more often than it goes lower, well, then I want to be able to buy the dip when I'm adding money. Now, of course, if you have a bearish strategy, then you could do the opposite. Really depends on what your strategy is. So now the question is, when do I buy this dip? Like, is this dip over? Right now I'm recording this midday Monday, and it looks like the market is making new lows. It's down over 3% right now. The S&P is wild. Nah, it's not wild. I mean, It's just because we've been lulled into markets only going up that it looks a little different. We're a little surprised, but this is just natural. But anyway, that's the question, right? Is this thing going to keep going lower? So should I buy now or wait for it to go lower? And it's a tough question, right? Because you never actually know. No one's able to say, oh, this is going to be exactly a 10% correction. So you need another system to tell you when to buy the dip. So talking to my partner in macro ops, Tyler, he was telling me how he does it. And he buys the dip based off what VIX is telling him. So VIX right here is just the volatility index. So if the market is dropping fast, you're going to see this pop. And they also call it the fear index because if there's more volatility, then it kind of shows that people are a little more scared. So you can use this index and what's happening here to help you decide when to start buying the dip. And this goes back to the famous Warren Buffett quote, right? Be fearful when others are greedy and be greedy when others are fearful. And the VIX is literally the fear index. So we want to buy into the fear. But then again, like what's a good VIX level? Well, Tyler has been trading the VIX long enough to know that 20 is the right level you should look for. I drew a black line right here to represent where 20 is. And right now VIX is at 23, almost 24. And you'll see it does pop above this level whenever there's a large correction. So we picked 20 because it's high enough that the market isn't hitting it all the time. You know, if VIX is above 20, you probably will see at least a medium term correction. But it's also low enough that you're going to get chances to add because you don't want to wait until the VIX is at 30 or 40 because that doesn't happen as often and you'll never end up adding to your account. And the number 20, it's not like a perfect number. It's just a marker. You don't need to be perfect with this. You just need a standardized rule set that you can follow. So I saw that VIX popped, you know, it's almost 24 right now. And what did I do today? The money I had sitting on the sidelines, I added to my positions. Now I had this money before and I wanted to add a while ago. And I was hoping I would get my chance with this dip right here at the end of January. But if you look at VIX again, see it was right around here, end of January, it didn't pop above 20. Actually, it did hit 20 intraday right here on the 31st, but it didn't close there. And you can see kind of the difference between hitting 20 like this and just being way above 20 here. This is a much better signal. So even though I wanted to add and I was waiting for VIX to get above 20, I didn't. And I waited. And of course, while I was waiting, I felt stupid. I'm like, oh, this market is never going to go down. I'm never going to get a chance. And sure enough, you know, a few weeks later, here we are. The market has gotten the actual drop and the VIX has popped pretty nicely. So, okay, you know the signal, right? VIX above 20, but now how do you buy? With how much? Do you do it all at once or do you do it in chunks? Because once again, you don't know if the market is actually going to stop going down. Like right now, this is almost a 5% from the highs, this correction, but who's to say it won't go 10%? Like I said, 20 in the VIX is a good marker, but that doesn't mean it can't go to 30 or 40. So we use 20 as a signal to start buying. So yeah, the truth is you could buy today like I did, and I might see all my positions turn red tomorrow. You don't know. It could even be the start of a market crash. You really don't know. And then, you know, I would see a lot of red with the money I just added. All you can really do is bet on the probabilities. And our research says that this is a minor correction and the bull trend should resume. So, okay, I'm betting on that. Now, to mitigate some of the risk, like even though VIX is above 20 and you're trying to buy with the dip, to mitigate the risk of it going lower, you can just put in a portion of your money. So like I said, you can start buying. So you can split your money into separate portions and buy as prices keep getting lower and lower. Now, this could work in your favor because if you only put in a little bit right now, then as the prices get lower, you know, you don't get hit as hard on that portion and you also get to buy more at an even lower price. But then a lot of times what happens too is that this is actually the bottom and the market starts turning up the next day. So if you only add a portion, then you're getting worse prices on the next few portions. But don't beat yourself up whichever way it goes. You're just trying to stick to a standard strategy. If you're following it, then you're doing well. Now, the time when I split up the money into portions is when it's a large amount of money I'm trying to add relative to my account size. Because if I have, say, a $20,000 trading account and I add in $10,000, well, whatever happens to that new chunk of $10,000, that's going to have a huge effect on my total account. So yeah, I might want to break that up and kind of mitigate the risk and the volatility a little bit. But if I have a $100,000 account and I'm adding $10,000, then maybe I don't care as much. So in my case, with the money that I just added, it was small enough relative to my account size that I just said, you know what, I'm going to put it all in at once. If the market keeps going lower tomorrow, the end of this week, whatever, I'm comfortable. I don't mind that dip on that smaller amount of money. And I really don't want to be as active. I want to put it in and then get away from the market because that's what works for me. Now, like I said, a dip can turn into a crash. Like, look at this. This thing just keeps dropping right now. And you never know for sure. And guess what? It is eventually going to happen if you're buying the dip. And when it does happen, you're going to get whipped. But if you have a full strategy in place with the proper risk control, then you're going to mitigate that whipping. If other investors end up losing 30% on a correction, you might only lose 8. And if you do that, you'd be way ahead of them over the long term. But again, for that to happen, you need the right strategy and risk management in place. That's how you can buy the dip safely. And that type of risk management is what we teach in in Strategy Builder Pro. There's 4 parts to a successful strategy: trade identification, position sizing, entries, and exits. We go over all of those and in great detail because, it's more complicated. There's a lot that goes into those 4 broad categories. And when you don't have your risk management in place, that's when you get screwed in market situations like this. And I had so many people texting me recently about how great they're doing, friends and family. They're like, damn, am I killing this or what? And I'm like, yeah, I'm glad it's working out for you, but the market's really, really strong right now. And I knew in the back of my head, as soon as everyone starts texting me about the market, that's usually when we're in for a correction. And sure enough, it's only been a few days and now we're getting it. And this is where you see the professionals get separated from the amateurs. It's in the rough times. In the good times, everyone's doing great. You buy anything, it's going up. In the bad times, when you get a market that's down almost 4% in the NASDAQ, that's where the risk strategy and the risk control that the professionals do, that's where it comes in handy. And that's the huge difference when you look at each person's returns over 5 to 10 years, and even in the short term, but it's much more pronounced over a longer time scale. So again, buying the dip, it can work, but if you're doing it without risk management in place, then you're gonna get screwed. So definitely check out Strategy Builder Pro. There's a link down below in the description and comments. Whether you're a beginner and don't have a strategy, or whether you're a pro, we've really taken everything we've learned at Macro Ops and piled it into this course. So you can build a strategy for scratch, or you can improve a strategy that you already have. Enrollment closes Sunday though, so definitely check it out now. And like I said, please get your strategy in place, get your risk management in place so that you don't get screwed. The bad times in the stock market are always around the corner. Sad but true. All right, smash a like on this video if you can. Comment down below with something if you have any questions about this VIX buying the dip strategy, or just say hi, whatever. And subscribe to this channel and hit that notification bell so you get future notifications when these new videos come out. I'll probably be doing a lot of videos this week just updating you on what's happening with the market. Subscribe and I will see you in the next one. Stay fallible out there. Bye.